Imagine this. You've got thousands of professionals, all trying to solve a hugely complex puzzle at the same time. It's high stakes, it's timed, and it's part detective work, part, legal navigation.
Right.
And then after all that, the game master just releases a report, a full dossier on where everyone went right, where they stumbled, and, the traps they walked straight into.
That is a very dramatic way to describe an accounting exam, but you know what? It's not really inaccurate.
It sounds like a thriller, doesn't it? But what we're actually digging into today is the Audit and Assurance Examiner's report from late 2025. And look, before you tune out at the word audit, just hang on. This really isn't just for aspiring accountants.
No, not at all. It's really a study in logic.
Exactly. We've been through the feedback on 3 big case studies: Color Co., Quirky Quad Bikes, and Survival Solutions. And the thing that stood out to me is how this report is like a masterclass in critical thinking.
Yeah.
It really shows the difference between just doing something and actually checking it.
That's the core of it. The examiner's report is fascinating because it exposes this very specific cognitive gap. It shows where really smart people confuse activity with evidence. They think just because they wrote something down, they've solved the problem.
So our mission today is to uncover those mental traps. We're going to look at rights, at controls, and at what I'm calling the timeline of truth.
Mm-hmm.
Let's start with the rules of engagement. This was the feedback from that scenario with Red & Co. taking over an audit from Blue & Co.
Right. Yeah, this was Section A. It's a classic bit of corporate drama. The directors at Color Co., they want to fire their old auditors, Blue & Co., and bring in a new team.
And the first stumble, the very first one the examiner points out, is about power. I think we all have this image of an auditor as this all-powerful investigator who can just, kick down doors. But the report shows a major misconception about the rights of the auditor who's getting fired.
It does. A lot of candidates just assumed that Blue & Co., the ones being removed, had this right to attend the board meetings where their firing was being discussed, or, to access company books afterward to defend themselves.
Which, that seems kind of fair, doesn't it? If you're firing me, surely I get a right to be in the room and state my case to the bosses.
Emotionally, yes, absolutely. Yeah. But legally, no. And this is where that precision really matters. You have to ask the question, who actually hires the auditor?
The shareholders, right?
The shareholders, the owners, not the directors. So the outgoing auditor has the right to speak at a general meeting of the shareholders. They can make their case to the people who actually hired them.
But they can't just crash the board meeting.
Exactly. The boardroom is the director's turf. The auditor has no right to be there unless they're invited. It's a really important boundary that students they missed it. They were confusing a sense of fairness with actual legal standing.
That makes sense. It's about who you report to. Okay, so speaking of distinctions, the report then moved on to the difference between assurance and non-assurance.
Right. Color Co. asked for a whole list of things: preparing financial statements, assessing controls, installing software, and the big external audit.
And the task was just to sort them into piles.
And this trips people up all the time because they think, I'm an accountant, so everything I do must be assurance.
Okay, so define it for us. What actually makes something assurance?
Assurance is all about confidence. It's when a practitioner evaluates something against a set of criteria and then gives an opinion to a third party. So the external audit. Classic assurance. You're telling the shareholders these numbers are true and fair.
Okay. And assessing internal controls.
Also assurance. You're giving an opinion on whether the system actually works.
So what about installing the accounting software? That feels pretty hands-on.
That's just technical work. You're building the system, you're not verifying it. It's like the difference between building a house and inspecting a house.
And preparing the accounts.
That's called compilation. You're just taking their data and putting it in the right format. You are not promising the data is true, just that it's formatted correctly. If they give you garbage numbers, you compile a very neat garbage report. You're not assuring the quality of the garbage.
So if I build the car, that's non-assurance. If I test drive it and sign a certificate saying it's safe, that's assurance.
That is a perfect analogy. And getting that distinction wrong means you don't even understand your own liability.
Now let's get to the part of this that honestly blew my mind a little. The negative conclusion. Color Co. wanted a review of their 5-year profit forecast. And the examiner said you just cannot give reasonable assurance on that.
Right. Reasonable assurance is that really high standard. It's the true and fair view we give on historical audits. But this is a forecast. It's a guess about what happens in 2030.
You can't audit the future.
You can't. Not unless you've got a time machine. You cannot verify that those sales are definitely going to happen. So what auditors provide is called limited assurance.
And this is where the language gets a bit strange, right? It's phrased negatively.
Yes. The opinion actually states, nothing has come to our attention to cause us to believe this forecast is unreasonable.
Nothing has come to our attention. That sounds like such a cop-out. Like, well, we didn't see anything obviously wrong, so good luck with that.
It sounds defensive, I know, but it's actually the only truly honest statement you can make. You can't say this is right. You can only say this doesn't look obviously wrong based on the assumptions they've used.
Okay.
Think of it this way. If I tell you it will definitely rain tomorrow, I'm just guessing. But if I tell you I see no clouds in the sky right now, I'm stating a fact about my current observation.
The examiner even joked about students trying to agree revenue to invoices for the forecast.
Which is physically impossible. The invoices don't exist yet. It just shows you have to completely shift your mindset depending on whether you're looking at the past, which is factual, or the future, which is purely hypothetical.
Let's move on to the second case. Quirky quad bikes. Best name in the exam, for sure. They make ready mixed concrete.
A messy business.
Yeah. And the feedback here was all about internal controls. This really felt like a lesson in pure logic.
It was. The examiner said candidates are great at defining what a control is, password, a signature, but they really struggle to explain why an auditor should even care.
So why do you care? If I'm the auditor, why does it matter if some guy in a warehouse signs a form? Why not just go and check the numbers myself?
It's all about efficiency and risk. If I can test your controls and they actually work, if I trust that your warehouse guy always signs the form and always checks the goods, then I can trust your system. And that means I have to do less of what we call substantive testing.
Define substantive testing for me.
That's the grunt work. That is digging up every single invoice, recalculating the math, physically counting all the bags of concrete. If your controls are garbage, I can't trust the system at all, so I have to do all that heavy lifting myself.
So good controls mean less homework for the auditor.
Essentially, yeah. But this is where the students fell into what the report called the specificity trap.
This is the warehouse assistant scenario. So goods arrive, and the assistant checks the quantity against the delivery note. That sounds pretty responsible.
On the surface, yes. But you have to look closer. They checked the quantity, but did they check the quality?
No.
Did they check it against the original purchase order to see if the company actually ordered this stuff in the first place?
Also no.
So they might have perfectly counted a shipment of boxes full of broken engines that nobody even wanted.
Right. And this is where students lost the mark.
Exactly. They would identify that weakness and just say, this could lead to fraud or error.
That's too vague.
Way too vague. It's lazy thinking. The examiner wants the business impact, you have to say. The company may end up paying for goods it never ordered, or production could grind to a halt because we accepted broken raw materials. You have to follow the thread all the way to the loss of money.
It's the difference between pointing at a fire and saying fire versus saying that fire is about to burn down the inventory shed.
Precision is everything. And the report also had a go at the advice students were giving. They called it action versus objective.
Give me an example.
Okay, so a student might write, ensure forms are completed. That's not a recommendation. That is a wish. It's an objective. It's like saying, achieve world peace. Great idea, but how?
So what's the better advice?
The fix has to be an action. Something like, the HR department should complete all new joiner forms upon hiring. You assign responsibility. You make it a verb. You make it something a person can actually do on a Tuesday morning.
And then there's the testing part, the observe fallacy. This one felt like it applies to anyone in management.
Oh, it does. The report points out that observation is a really weak test. Think about it. If I stand there with a clipboard watching you count inventory, are you going to do a good job?
Of course. I'll be the employee of the month while you're standing there. I'm not checking my phone. I'm counting every single bolt twice.
Exactly. It only proves the control works while the auditor is looking. It's the Hawthorne effect. The examiner was clear that inspection is so much better. Go look at the documents from last Tuesday when nobody was watching. Is the signature there? That's the real evidence.
The difference between a staged performance and a paper trail. Okay, let's pivot to survival solutions. A medical equipment manufacturer. High stakes, high risk.
And the feedback here was almost all about audit risk and documentation.
There was a point about documentation that seemed to really annoy the examiner.
Yeah.
Students were describing what documents are like. Oh, a flow chart is a document, instead of explaining their purpose.
Right. The purpose of documentation isn't just to create a pile of paper, it's to record the work you've done to support your final opinion. Because if it's not written down in the eyes of the law and the regulator, it just didn't happen. You can't say, oh, but I checked that in court if it's not in the file.
But where it got really interesting for me was the ratios, the sort of detective story hidden in the numbers.
Ratios are the absolute heartbeat of audit planning. In the Survival Solutions case, the receivables collection period, so how long it takes customers to pay their bills, had gone up quite a lot.
And the scenario mentioned the company had offered longer credit terms to attract new customers.
So you connect the dots. Customers are taking longer to pay, and we are legally letting them take longer. That creates a very specific risk, the overvaluation of receivables.
Meaning, we're saying on our books we have all this money coming in, but the longer it takes, the less likely it is we'll actually see any of it.
Precisely. Old debt is bad debt. Are these receivables actually good assets? Or are we just holding on to a fantasy? If you just do the math without connecting it to that risk of bad debt, you've completely missed the point. The number tells a story about risk, not just arithmetic.
Then we have that issue with the financial controller. They left, and there was a 4-month gap before the new one started.
A very dangerous time for any company. No one's minding the store.
And a lot of students apparently reacted by saying, tell the company to hire a new one immediately.
Which is great advice if you're a management consultant. But you are the auditor. You can't tell them who to hire. That's just not your lane.
So what is the auditor's lane then?
Your job is to recognize the risk that was created by that 4-month gap. No oversight for that long means errors probably slipped through. So your response is to say, maintain professional skepticism and increase substantive testing for that specific 4-month period.
You're not fixing the broken window. You're just checking to see if the rain got in.
That is a beautiful way to put it, yes. You assess the damage, you don't do the repair.
One last point on Survival Solutions. The warranty provision. This felt like a real math trap.
It's all about paying attention to the story. Survival Solutions had switched to a cheaper supplier for some parts.
Which almost always means lower quality.
And warranty claims increased, more things were breaking, but, and this is the kicker, the warranty provision account balance, the pot of money set aside to pay for those fixes, it stayed exactly the same as the prior year.
So more things are breaking, but we haven't put any more money aside to fix them.
That's the audit risk right there. The math of the provision doesn't match the reality of the business operations. It strongly suggests that the liabilities are understated.
That feels like a very common corporate trick. If we don't acknowledge the cost, maybe it won't exist.
Exactly. And the auditor's job is to spot that exact disconnection between the narrative, we have more claims, and the numbers, our provision is flat.
Okay, final segment, the timeline of truth. This is based on Flatiron & Co., who are dealing with 2 clients, Tribeca and Chelsea.
Yeah, this section was all about timing, specifically things like continuous inventory and cutoff.
Let's start with Tribeca. They don't do a big shutdown to count everything on December 31st. Instead, they count little bits of inventory all year round.
Which is super common now. But for an auditor, it's a bit of a headache. You can't just show up to the count because there isn't one single event.
So how do you audit it?
You have to audit the process. You review their schedule of counts. You have to verify that their system ensures every single item gets counted at least once over the course of the year. And crucially, if they find a mistake, the computer says there are 10, but they only count 8, do they actually investigate and update the records?
So you're auditing the system's integrity. Okay, now what about that purchases versus payables mix-up? The report called this a classic error.
Oh, it happens every single year. Purchases are the activity, what you bought during the year. Payables are the balance, what you happen to owe at the very end of the year.
And the confusion happens with cutoff testing.
Yes. Cutoff is just answering the question, did this transaction happen in this financial year or next year? Students tend to look at the invoice date. But invoices can be delayed, they can be dated wrong. I could send you an invoice dated December 31st, but if I didn't actually ship the goods to you until January 15th, did you really buy it in December?
I guess not. So what's the source of truth?
The GRN, the goods received note. That is the piece of paper that proves the physical stuff crossed the threshold into your warehouse on a specific date. That's the moment the obligation really starts. Students keep looking at invoices, but the GRN is the timeline of truth.
That really does sound like forensic accounting. You're looking for the fingerprint, not just the receipt.
Exactly. The receipt is a claim. The fingerprint is the evidence.
And finally, we have this subsequent event with Chelsea Co., a lawsuit that got settled after the year end.
This is IAS 10 territory. So there was a legal claim for $0.6 million that was pending at year end. After year end, they settled it for $0.4 million.
So the question is, do we need to change the financial statements for the year that's already finished?
The rule is this. Does the event provide evidence of a condition that existed at the balance sheet date? Well, the lawsuit definitely existed back then. The problem was real in December. So the settlement in January just clarifies the value of that pre-existing problem. It's what we call an adjusting event.
But here's where the math matters. Which number do we care about? The original $0.6 million claim or the $0.4 million settlement?
A lot of students tested materiality against the $0.6 million, maybe because it was the bigger number or it was the number in the draft accounts. But the $0.4 million is the real number. That's the actual liability. That is the number that needs to go into the book. So that's the number you have to test.
So you don't audit the fear, the $0.6 million, you audit the reality, the $0.4 million.
Correct. You audit what the number should be.
It's amazing how these scenarios force you to stop and just think, what is actually happening here? Rather than just applying some formula you memorized.
That is the mission we talked about right at the start. It's about moving from rote learning to genuine comprehension.
So if we pull all of this together, we've looked at rights, controls, risks, timelines. What's the big takeaway from this report?
The core theme really is precision. It's about distinguishing between an action and an objective. It's knowing the difference between inspecting a document and just observing a person. It's knowing that shipping something and billing for something can be two very different events in time.
And understanding that you can't audit the future with the same level of certainty as you can the past.
Right. And for you, the listener, even if you are never going to be an auditor, this all matters. It shows that being right isn't just about getting to the final number. It's about the quality of the evidence and the logic you use to get there. You can get the right answer for the wrong reason, and in an audit and in life, that's a dangerous place to be.
You can guess and get lucky, but you can't build a reliable system on luck.
Exactly. Luck is not an internal control.
I want to leave everyone with one final thought today. We talked about limited assurance with that profit forecast. The idea that the auditor concludes, nothing has come to our attention to cause us to believe this is unreasonable.
The negative conclusions.
It sounds pessimistic, doesn't it? But maybe it's the most honest statement we can make in a complex world. We are just drowning in information, and everyone wants to be 100% certain this is definitely true. That is definitely false.
But so often we just don't have enough data to be that positive. We can't see the future.
Exactly. So maybe there's real value in just admitting what we don't know is wrong rather than pretending we know what is definitely right. Applying a little bit of that professional skepticism to our own opinions.
I think that's a very healthy way to look at the world. It's okay to say, I see no evidence that this is wrong, rather than just screaming, I am right.
Something to think about next time you're asked for a guarantee on a future outcome. That's it for this deep dive into the examiner's report. Thanks for listening.